You do not want to miss this episode. We're going to dig into buy term and invest the difference. Is that a brilliant strategy or is it a no good, rotten idea? Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell, and joining me as always, Christina Wyatt. Christina, how you doing?
Hey, Darren, I am doing great. Excited for another episode in the studio.
I'm pumped for this episode. This is a question we get from one of our followers. We love questions. Keep them coming. Pretty excited to jump into it. What do you want to say before we dig into it?
Yes, before we get started, I just want to remind everybody, if you're listening on your favorite podcast platform, please subscribe and leave that 5-star review. And if you're listening or watching on YouTube, please like, subscribe, and hit that bell button so you always know when new content is coming out. And don't forget to follow us on social media at Control and Compound on Instagram and TikTok.
All right. First of all, I got a sort of a public service announcement. I want to get some of these things out of the way about some of these myths out there. So I got some myths that I want everyone to know about. So here's a few myths. Chewing gum stays in your stomach for 5 to 7 years. Not true. Wait an hour after eating before you go swimming to prevent cramping. Not true. Sitting too close to the TV will make you go blind. Not true. You lose most of the heat through your head. Not true. Cracking your knuckles causes arthritis. No, Mom, it's not true. Breakfast is the most important meal of the day. No, not true. Shaving your hair makes it grow back thicker and darker. I can attest that that is not true. And finally, buy term and invest the difference is a great strategy. We're going to tell you today that's not true either. All right, Christina, let's dig into buy term and invest the difference. And let's talk about sort of what it is. And then there's absolutely pros to term insurance. So we don't want to mislead our listeners thinking we don't like term insurance, but let's just kind of take it from the beginning. What is the strategy buy term and invest the difference?
Yes. So with a buy term, invest the difference is they're advising that instead of purchasing a permanent life insurance policy, like a whole life insurance, high cash value life insurance policy, we talk about universal life policy, a permanent plan. So in life insurance, we have term insurance, we have permanent insurance. Permanent insurance can have a higher price tag to it. So what they're essentially saying is buy the cheap term, the inexpensive stuff that lasts for 10, 20 years, take the money that you would have paid for that permanent insurance and invest it in the stock market, and you will come out better long term. That is the philosophy here that they're going for with buy term, invest the difference.
So buy the cheap term insurance, okay, like inexpensive term insurance, use the difference to fund that. So let's just talk kind of big picture on this, because there's so many pieces to that. And in theory, people go, oh, that's great. We can get a better return than insurance. That's great. So I want to talk we talk about retirement mountain. There's the accumulation up the mountain where you're saving. And then you get to the top of the mountain. And then there's the distribution phase. You're retired, you're coming down the mountain, you're spending money every year. And most financial advisors really only teach you how to get to the top of the mountain. Can I help you save $1 million, $2 million, $5 million, whatever your number is? But really, you get to the top of the mountain and then you're almost abandoned because you don't have a plan to come down the mountain. And if I was hiring someone to take me up and down a mountain, I'd want to make sure the guy knew how to take me down. So let's talk about that. On the going up the mountain part, what are the huge advantages of having cash value life insurance, in your 20s, 30s, 40s, 50s, as you're accumulating up the mountain? What happens in life that you may need access to money?
Lots of things every day.
You can have children?
Lots, everything, anything. Once a week, something happens, right? You've got emergencies, you've got opportunities that pop up. On your way up, people want to typically purchase their first home during that accumulation phase. Some want to start businesses, want to send their kids to school. There's lots of different things that are going to pop up along the way. A roof goes on your house. That's all things that are going to pop up on your way up retirement mountain for sure.
Okay, so if I save my money in the stock market or in a GIC or outside of a whole life in this example, and I'm year 10, and great, now I've saved enough to go buy an income property or start a business. What happens to that savings? Does that continue to save when I cash it out?
No, it stops. You've cashed it out, which is typically what happens to most people, right? They save in instead of saving in savings accounts, they save in investment accounts, because I think that's something we should touch on as well. And then they need to withdraw from their investments in order to deal with those emergencies that pop up or opportunities as well, right?
So again, it goes back to those wealth destroyers, taxes, fees, volatility, and spending. We're on the compound interest curve. We're saving, we're saving, we're saving, and then we're going to spend it right down to zero, and we're going to restart the compounding. And if you look at most Canadians, they're continually saving, going back to zero, saving, going back to zero. So, what are the advantages of whole life if I save in that whole life instead when the opportunity or emergency comes along?
Yes, absolutely. So and you're not blowing those savings that you've had. You know, saving for Canadians is a huge problem. One, we just don't see it. So this invest or buy term invest the difference, I think blows up almost immediately when you're just trying to save. Like it's not systematic, right? So are people actually going to save inside of this investment account? And human nature says that if the money needs to go somewhere else, they're going to put the money somewhere else, which I think is a huge thing as well when we're looking at the life insurance policy where we're going to be setting up our savings and this, you know, that uninterrupted compounding for us. It's not going, we're going to do it. We're going to put that money in. We've kind of set ourselves up for that systematic savings plan. Where on the investment side, are you going to do it for
No,
sure? If an opportunity comes up, you're going to stop, right?
it's typically it's buy term and spend the difference is what I find people do. But back to that example. So great, in 10 years now, instead of cashing out that GIC or stock market, if I have whole life, I can borrow against that cash value and allow that money that's in my cash value, the full amount, because I'm not borrowing my own money, the full amount to compound for another 40, 50, 60 years. And when you start running the math on that, like there's no comparison. Like it's millions of dollars difference if you can continue on that compound interest curve instead of going right back to zero. And when we think of, to your point, Christine, you talked about savings, and I'm glad you brought that up. Let's say you're a business owner, you're real estate, you're an individual, you're looking, individual saving for a house or car, or start a business or get into an income property, or a real estate investor looking for their next property, a business owner looking to expand. Are you really investing that money, say, in the next 0 to 5 years, or are you saving? And most people in those situations need to save money. If I'm going to buy a house or an income property in 5 years and put money away every month, I'm not going to put it in the stock market because what if in year 4.5, before I'm ready to buy, the stock market drops 40%? So I think that's a little misleading in buy term, invest the difference because we're skipping over that savings part. And savings is the first thing you should be doing. We talk about the rock solid foundation of our financial plan is savings. So it's the savings you should be doing. So now we start comparing a savings account to the whole life. And again, there's no comparison. So let's do some actual math on this. So Christina, if I put $10,000 a year into properly structured, dividend paying, high cash value life insurance policy, my death benefit's going to grow to millions. I get that. But what about just the cash here? Let's forget about the death benefit for a second. Just the cash, ballpark. How much is my cash? That my $10,000 a year going to grow long term?
Yeah, so I like that you said just the cash because I do think that with the buy term invest the difference, they're only focusing on the cash. They're forgetting about the death benefit altogether, right? Which we'll touch on again soon. But cash value inside the policy grows at about a 5% after tax rate of return. So 5% after tax,
Okay.
what you're going to make.
Yeah, it's 5% after tax because there is no tax. There's no
Yes.
tax slip. It doesn't show up anywhere. So we get a 5% net return. Now, if I put that same $10,000 into a 10% GIC and I'm in a 50% tax bracket, I'm going to net about 5%. So literally, it's like a 10% GIC long term. Now, if I put $10,000 into a GIC, I don't have any life insurance. So the buy term is, well, why don't we take $1,000 of that 10,000, keep my example simple, and now we put $1,000 into term insurance, okay? We don't need to do that with the whole life because it comes along for the ride. Now we only have $9,000 to invest. So you only have $9,000 to invest and you need to net a 5% return to match the whole life. Well, now we're talking, what, 11 plus 11% rate of return that you're going to need to net the same as the whole life. And even if we include the stock market in this, and people, oh, well, I can earn more money on the stock market. I would say, great, maybe for a long-term investment, but not for a short and medium term if you're a real estate investor or business owner. But let's just play the stock market out. Let's say the stock market earns 8, and let's say you pay a 1 or 2% fee and you net 6, and on that 6 you pay 33% tax, say, just a third, keep it simple. You get some dividends, some bonds, some mostly equities. Well, now your 6 is your netting 4. or we can go 10, 8, and 5. Like even at an 8 and 10% overall stock market return, if you take that money and you deduct the amount you'd have to put in term, then you deduct taxes, your net return's going to be similar, and the advantages and the pluses of the cash value life insurance are night and day. Talking about the and opportunities. Everything is an or, every other asset's an or asset. This is an and asset. Put your money in here and do that. Any comments on that? What did I miss, Christina?
Yeah, so just on the investment side, we talk about comparing it to the GIC, and that's a fair comparison considering it's a savings account, not the investing side of things. But we, like you mentioned, you have the and asset. So if you do want to make bigger returns, take it and leverage it and put it into those other investments. So you can get a higher return should you want to as well. You can actually do both. You're not giving up one or the other. Now, I will go back to your point on or your mention on the death benefit that we're not going to have term insurance because we've got it built in. And I'm gonna say that's not correct completely, Darren. And I think listeners long term, and I think listeners will also agree that a big problem with sometimes people selling permanent insurance is that they're not talking about the need for term insurance as well, right? So someone that might need term insurance is now just getting a permanent policy and they're not actually getting protected for what they need on the term insurance side because the death benefit's not big. We drive down the death benefit, right? We know that. Long term, it's going to be huge, which is awesome, but you definitely still need that term insurance. So don't, let me be very clear on that. When we talk about buy term, invest the difference, get yourself a permanent whole life policy, that does not mean that that's going to cover all your life insurance needs. And you can ask any one of my clients when I sit down with them and we have this conversation, I'm like, this death benefit is not 20 times your income typically. When we set these policies up, you're probably going to need some term insurance. And I think that gives permanent insurance a bit of a bad name when financial advisors or insurance brokers are sitting down and they're saying, oh, you can just get this permanent policy. You're good. You're completely covered for everything you need. No, you probably do need some of that term insurance too, right? We need a bit of both of it for a good plan.
Yeah, I'll be honest. When I started out of my career a few years ago now, my first couple of years, I thought whole life was terrible because the only people I sort of saw that were buying it, I was starting new, right? Is you've got young people maybe in their 20s with a non-working spouse and a couple young kids at home, and the insurance guy would knock on the door and say, "Hey, you need whole life," and would go in and sell them $100,000 death benefit, and $75 or $100 a month going into this policy, and I would just like see that after the fact and go, that's the worst advice you could give that young family. That young family needs a lot of term insurance. What if that working spouse dies and the non-working spouse is home with 3 little kids? Like the need for term insurance, especially in the younger years, or when you have a short-term liability like a 20, 25-year mortgage, great. I love term insurance for that. Business owners, some buy, sell. I love term insurance for that. But term insurance, you only get to benefit if you die. So I don't like the having to die to benefit from it. And if
in 10 years, too.
Yeah, exactly. Die the next 10 years for a 10-year term. But if we look at the stats, the amount of term insurance that pays out in Canada is ballpark around 1%. And that is by design. The insurance companies design term insurance to go up either typically every 10 or 20 years. The rates start getting progressively higher and higher and super high. And then eventually it's just going to terminate completely when you can't afford the premiums, that doesn't make sense financially, or the product itself terminates at 70 or 75. So the insurance companies love term insurance. It's their favorite product to sell. They would much rather you buy term insurance than you buy whole life. Term insurance is simple. It's math. We pay out 1% of the claims. We get to keep all the premiums for the people that don't end up dying in that period of time. It's great. So 1% chance term pays out. If you have a whole life and you keep it for the rest of your life, what are the chances that's going to pay out?
100%. 100%.
100% chance you're going to die.
Yeah.
Even with all this new technology, you're going to die. Okay? So the death benefit is a real meaningful conversation. To your point, yes, we may need some term starting out. We may need some term for periods in our life. But what happens in retirement when now your term is expired? So now you're a business owner, real estate investor. You've got money in your RRSPs where half of it or more is going to go to CRA. Then the planning opportunities go away. That's now when we're at the top of the mountain. We've saved, we hit retirement, and now we're going to come down the distribution phase, and we get 2 elements of the distribution phase. How much can I spend in my retirement? And what happens when I die to my assets? So let's talk about each one of those. When you go to spend money in retirement, what's a typical percent? If forget about insurance for a sec, what's a typical percent that people can safely spend and not run out of money, like a safe distribution rate?
Like a four
Yeah,
or five.
the
Yeah,
4%
four or
rule,
five.
right?
Yeah.
So you get $1 million, you're gonna pay out 4%. Now, and that was just based upon a Monte Carlo, a bunch of formulas. Why is that $1 million 4%? And no one tells you that when you're saving, right? Hey, you're gonna have $1 million when you retire, but no one says you're gonna have an income of 40 grand when you retire, maybe 45. Like that doesn't sound near as exciting. But now, if you have that permanent death benefit, the amount of things that you can do differently in retirement to spend much, much more. And we'll just highlight a couple ones. We've got other podcasts and videos on this. The volatility buffer. If you have a uncorrelated asset like whole life, and you've got a stock market portfolio in retirement, great, it's fine, unless it goes down and then you have to sell that year to survive, to earn money or to live off. Money goes down, you sell, there's no recovery. Money goes down and you access a loan from your cash value to leave your stock market stuff a chance to come back. The math on that is you're able to take out about 50% more if you have at least 2 to 3 years of earnings, 2 to 3 years of income in a cash value life insurance. So instead of 4%, maybe you can take 6, 7% out. What about borrowing the cash value? We can now, this death benefit also has this massive cash value. Those loans against cash value, completely tax-free. And then the last one I'll mention is the death benefit. People don't get excited about the death benefit usually until they get a little older. If you have millions of dollars of death benefit because you bought this for the cash value, but a death benefit came along, when you hit retirement and you've got $1 million, $2 million, $3 million of death benefit, when you die that money's coming in. So it's a permission slip to spend your money differently. So I plan on going to my income properties and saying, I'm going to refinance the heck out of those, get all that tax-free money, spend it in my lifetime, die owing a bunch of money. Who cares? There's a death benefit that's going to cover that. Personal residence, get a line of credit on your personal residence, spend an extra 50, 100 grand a year, die owing $1 million on your $2 or $3 million house at the time, 40 years down the road. Who cares if there's millions of dollars? So I just think the buying term invest the difference is just so short-sighted. It looks at one little snapshot of, oh, if I took that money and put it in the stock market averaged this. They don't tell you, what about when the stock market's down and you need to access money? What about when an opportunity comes along and you don't have to put your compound interest curve back to zero? What about when you retire and you can only take half as much of an income because you don't have permanent insurance? And lastly, what if you die now at 72 or 78 or 85 or 90 and there's millions of dollars now owing in tax? Well, your term insurance is long since expired. Now your family's having a fire sale of assets to try to pay the tax bill. Is that what you worked your whole life for? Or do you want that permanent death benefit there that you can effectively spend a lot of it in your lifetime and the rest of it go to pay those taxes, to pass on to your family, to do an equitable distribution of your estate? Maybe one child's in business, one's not, one child is whatever. So I just think it's so short-sighted. So sorry, I rambled a lot there, Christine. I just get passionate about
I
this
was gonna say,
because I don't like the insurance guys that say term is stupid, because I think that's a horrible. I love term insurance. It's wonderful. But it's like apples and oranges. Term insurance and whole life are accomplishing two significantly different things. Term insurance is perfect if you have a temporary problem, like what happens if I die in the next 20 years? How does my family provide? What happens to this mortgage if I die in the next 20 years? But it's nothing to do with what whole life is really doing, which is long-term death benefit, long-term tax-free growth, long-term tax-free income at death, access to money, the ability to multiply my money into an and asset. It's just night and day. It's just not a fair or accurate comparison to say those are the same things.
Yeah, and it's not planning. Buy term, invest the difference is not planning. I definitely think that you should buy term, and then I think that you should look at setting up the foundation for your financial plan, getting your savings in place, building up that foundation, and then taking it and going investing. Now, I think you should invest in yourself, business and real estate, but to each their own, right? To sit there and say, we're just going to disregard that and we're going to focus on sticking everything into the stock market and buying term insurance. It's not a plan. Like there's no plan to that, right? That is, which is what makes it a myth. It's not a good strategy to follow because there's no strategy behind it. Right? We don't actually know what the plan is here. It is going to make it look much better from an accumulation phase on the way up retirement mountain, which is why a lot of financial advisors like it, right? Because when you come in and you talk to them about your investments every year, well, if that investment looks to be larger based on what you've put in it, then they're doing a good job, right? That's where it
They
comes
don't mention
from.
you lose half of it when you
No,
go to
they
take it
don't.
out.
Yeah, exactly. The RSPs and they're not talking about the taxes. They're not talking about the decumulation phase of your retirement. They're not talking about needing that permanent insurance for your estate planning down the road. Like it's like you said, it's extremely short-sighted to think that and we've already kind of debunked it, that even from the investment return side of things, we are able to do better. And I think when they did, when this came out and was a little bit more popular was when a lot of people were buying universal life policies where they are invested in the stock market inside of those policies, right? And they were like, well, if you're going to do that, take it and invest it elsewhere, right? And yeah, we don't really believe in investing in the stock market in your life insurance policies either. No. But disregarding permanent insurance entirely is crazy, right? We know that this stuff's been around for 150 plus years and has been doing exactly what it needs to do. Why would you disregard that from your planning? It just doesn't make sense, right?
Yeah. So I guess kind of to sum up, when does term insurance make sense? When you have a short-term liability. If you're not saving money, you're not ready for whole life, right? Whole life is really a savings plan. So if you're a 25, 35, 40-year-old and you're struggling to pay the bills every month and you have a family and you have a mortgage, you need term insurance. That is you 100% need term insurance. But if you're in a situation, I don't care if you're 18 or you're 50, where you're saving money each month, your money needs to reside somewhere. And, we can show you the math. We can show you all the benefits. There's no better place than for it to reside in your cash value your whole life when you talk about tax, volatility, opportunity, and asset, death benefit, all that stuff. So that's when you kind of enter the whole life phase, is when you start saving. If you're not able to save any money month to month, great. You need to figure that out. You need to invest in yourself, I'd say, to increase your income, or you need to reduce your expenses. But that's where you're looking at term. You have a large purchase, you buy a business, you buy a house, you buy a real estate property. Great. There could be a real need for term insurance there. It's perfect if you have a short-term, temporary problem for a term of 10 or 20 years, then it's awesome. But your life is a long-term problem, not a short-term. So that's why the permanent whole life, long-term, blows it away financially, blows it away peace of mind, blows it away for opportunities and emergencies. If you want to be wealthy, you need to be in control of your money. Anything else, Christina?
No, I think you covered a lot there,
All
Darren.
right. All right, so that's our opinion on buy term and invest the difference. We love term insurance, but we think properly structured whole life is a million times better, and hope we convince a few people today. All right, thanks for watching. Thanks for listening. Have a wonderful day. Thanks for watching this episode of Control and Compound. Don't forget to subscribe and hit that bell button so you never miss a new episode. And if you're ready to learn more, head to our website, controlandcompound.com. The link's below.